All right. So when Microsoft last updated investors, they told us that their overall revenue increased by 13% up to $70 billion. Their gross profit margin jumped by 11%, and the gross profit margin came in at 69%. Operating income increased by 16% to 32 billion, and their operating profit margin stayed at 46%, which is an incredibly robust operating profit margin for any company in the world. It's one of the highest operating profit margins of any of the companies I'm following. Some of the ones that are better, there are a few that are better in terms of operating profit margin, include Visa, MasterCard, Taiwan Semiconductor, Nvidia, and there's a few others I can't think of off the top of my head. But Microsoft is definitely up there among the leaders in terms of the best operating profit margin. And it's even more impressive when you combine with revenue growth and operating profit margin. Microsoft surpasses Visa, MasterCard in revenue growth, to be sure, although Nvidia does generate better revenue growth and better operating profit margins than Microsoft, at least in the previous few years and for the next few years as well. So let's look at some valuation figures, starting with my proprietary discounted cash flow valuation model, which calculates an intrinsic value per share for Microsoft at $434. Current market price is $510. Microsoft stock is looking a little bit overvalued now following this huge increase at the current market price. Now, when I go to fiscal.ai, which is my preferred data source, and they save me a lot of time, let me tell you. And the forward price to earnings on this looking ahead is 35. So the highest it's been all year long. So the valuation is getting stretched, both in terms of the forward price to earnings ratio and my proprietary discounted cash flow valuation calculation. So in combining all of those things and answering if you should buy the stock before earnings, I would say no. Click the link below to watch the full video.